Hey guys, yeah, so my name is Tigran. It's really nice to see you here. I mean, I see there's people from everywhere, really resonates with Go Global. Um,
Yeah,
I,
let me just before you do an introduction, I just want to say a few
uh,
words. I know Tigran like so long, and he's a great friend of mine, but also a partner, a co-founder. What we are doing, and we are helping like our business is just helping hundreds of companies, like literally for so many years, and we've gained. So much expertise knowledge not just from taxes and accounting but from your internal business perspective. So we know so many things related to taxes and accounting. You may ask all of this, and Tigran is always on the backstage. You see him less, but he's the one with along with our team doing so much for your businesses to succeed. So this is the time you can ask him questions. He will give you some latest updates on 2026. This is the topic today, but use this opportunity if you're trying to file your taxes or you need to comply with some tax regulation, or you probably got a fine or something that you are not sure about. We are here for you. But here it is, Tigran, the floor is yours. Say a few words about yourself. Why you're so cool, and why so many customers of ours love you so much, and let's get into it.
yeah, thank you, Daniel. I mean, yeah, you hit the nail on the head. You know what we basically do, and we've been doing this since what, like 2020, is to make sure our customers never have any issues with their taxes. But that's, I guess, the bare minimum most accounting firms promise. We also do something called tax planning, right? So we're basically we ensure we work with the client during the year to ensure they pay the least amount of taxes possible without raising any red or even yellow flags with the IRS, right? And people often ask me, what's the difference between tax planning and tax filing? I mean, tax filing is basically the process of sending your tax return to the government. And given that we have technologies, we have AI, that's fairly simple process, right? And it may take me maybe, I don't know, like 45 minutes to submit a tax return. But when it comes to tax planning, it can take me days or even weeks, because tax planning involves basically using the tools given by the Congress, put in our disposition by the Congress, use accounting tools to such as smart business deductions, such as tax credit, such as choosing the correct jurisdiction, such as profit deferral or revenue deferral, to basically pay the least amount of taxes, right? And that's our real job right now. Um, I imagine we have people who may be very experienced in like what they do, and they've been filing taxes for many years. But there also may be people who are just maybe thinking of starting their business, or maybe they're new to the United States. This is their first tax return. So while today's main topic is basically the one big beautiful bill's effects on the US taxation, I will also go over the general taxation in the United States, just give you an overview, and you can of course ask me questions about that too, right? Now, so in the United States, we have two forms of taxation, essentially speaking: corporate and individual, right? Corporate is basically when you create a separate tax entity, which is a typically a C corporation, or some LLCs can also choose to pay taxes as a C corporation. Then your gross revenue, which is typically your sales, also additional income received, such as interest from banks, rewards, some grants, less your operational expenses, less a reasonable salary you pay yourself, right? Whatever remains there is your net income, and you pay tax on your net income, right? And in the United States, the corporate income tax rate is 21%. Um, and basically, once you pay that, the rest of the earnings stay in your retained earnings, which you can use to pay yourself additional dividends, or to pay the shareholders dividends, or you can reinvest in a corporation, right? Or the individual taxation, which basically means all your income flows into your personal tax return. You combine them together, then you use different deductions, um, such as, when you pay for medical expenses, God forbid, when you pay for your children's daycare. And then from your net income, you basically calculate your tax, which is typically between 10 and 37%. And then also, depending on your state, you may also pay individual state income tax, right? So, and when we talk about tax planning and tax strategies, we are also including that, right? If if you reside in the United States, you can either keep your taxes separate by using C corporation or corporate taxation, or you can flow everything into your personal tax return, and you pay taxes from there, right? Now, what is OBBB? It's called One Big Beautiful Bill. I mean, sorry, I can't do Trump's impression, but the way he says it probably sounds even more exciting, I guess. Okay, what is One Big Beautiful Bill, right? So, and I guess we can go to the next slide. Okay, so basically, it was an omnibus bill, which included also provisions to basically designed to reduce the tax burden from businesses, right? And especially from the corporations, right? So the key provisions is that the corporate tax rate in the United States remains 21%. There was a lot of push to increase the corporate tax rate, but it stayed the same, right? So meaning if you have a corporation, and I assume many startup owners have C corporations, you pay 21% flat rate on your net income, regardless your net income is $10 or $10 billion, right? Um, Now, something even more important is the bonus depreciation, right? So now, what is a bonus depreciation? Generally speaking, right? So if I'm paying someone for a service, right? Let's say if I use Dmitri's legal services, right? So that's an expense for me. I can deduct it from my from my taxes, right? From my revenue. If I buy some subscription online, right? That's a one-time service or a recurring service. I typically can deduct it as an expense, right? If I buy airplane tickets, um, I can deduct it as an expense because it's one-time service. However, what does happen if I buy a car? Now, in common sense tells us, okay, I spent money, I bought a car. But in accounting terms, it's not the same, right? So the way the accounting will see this, I had $20,000. I gave it to the car dealership. Now I have a car that's worth $20,000, right? So I didn't really spend money in accounting language, in accounting terms, right? So in other words, if I'm a taxi driver and I spent $20,000 to buy a new car, I cannot deduct it from my revenue, right? So if I made $50,000, I cannot deduct the $20,000 car from my revenue. Instead, what I should do, because with the time my car gets older and its value basically depreciates, I get to deduct that, right? And I don't want to go too much in details how many different methods of depreciation exist. However, generally speaking, for things like a car, you would divide it by 5 because it is generally assumed that car lasts about 5 years. And so if with a $20,000 car, you would typically divide it by 5 and you would only be able to deduct $4,000, right? Even though you actually paid 20. So in other words, your cash flow statement would show that you spent $20,000, right? So you may be completely out of cash on your bank account. However, your net income, your accounting would show that you still had $16,000, right? So, and that's an interesting catch that many people unexperienced with accounting and taxes often tell me, hey, but I spent so much money. Why am I paying taxes? I'm like, well, because of the depreciation. Now, luckily, bonus depreciation allows small businesses to basically write off the assets based on basically their cash, based on their cash value, right? So, meaning, let's say you bought a car and you put it in service after January 20th, I believe, right? So at that point, let's say the car's price is, let's say, $40,000, right? And in that case, if the car is over meet certain qualifications, it's generally over 6,000 pounds or more. So you'll be able to deduct the full $40,000. And this also applies even if you financed your car, right? So meaning I financed a $40,000 car or even more. Let's say I financed a $70,000 Tesla or a $100,000 Mercedes, right? I uh, I still get to deduct the full price of the car as long as it's used in business and as long as it meets the qualifications. Now, for smaller cars that don't meet the qualifications, you get to deduct up to $22,500 for the first year. So that's still a big increase, right? So So bonus depreciation is something that lets you save a lot of money on taxes. So this is probably one of the most important ones, right? Now, estate and gift tax exception remains historically high. So what is this? I get a lot of questions from my clients. Hey, what if like my mom gave me like $100,000, right? What if like my sister gave me $20,000, right? I mean, do I have to pay tax on it or not? Um, the answer is generally no, because you get a lifetime exemption of up to $15 million, right? So it was increased to $15 million. Uh, so uh, especially if you, let's say, just move to the United States, right? Or let's say you have a parent who wants to make you a large gift, or someone else wants to make you a large gift, right? So in that case, typically you get to exclude that from taxes for up to $15 million. Of course, there are with a lot of restrictions, with some restrictions and some exceptions, right? So, and then there's, so we can probably go to the next slide, and we can talk about also research and development expenses. Um, when it comes to, and we'll talk about obviously the tips and the overtime, we'll talk about the individual taxes too, but when it comes to research and development expenses, so what are research and development expenses? Typically, most of the backend software development is research and development, right? So different lab studies, right? So basically, whenever you are conducting studies to figure out to create something that can be used in a future product, right? So your software, the backend of your software now, you can typically exclude from research and development things like bug fixes, QA, or things like feasibility analysis, consultations. But typically, the code itself that can be reused is considered an asset, right? And assets typically cannot be depreciated, right? So, and from 2021, the law was passed, right? So basically, IRS, and from 2023, IRS said they will start enforcing it, meaning if you paid your software developers, right? And many startups, I assume, pay a lot of money to their developers. You must consider that as an asset, as if you bought a car, as if you bought an equipment, right? And so let's say, again, we look at your cash flow, right? You have $100,000. You spent $90,000 to your software developers, right? Now, typically, you only get you cannot depreciate all of that, right? You cannot write off all of that. You have to depreciate it over the course of the time. So what does this mean? US-based research and development, before, you would have to depreciate it within 5 years. So you paid $100,000 to your developers. Typically, you only get to deduct 1/5. And during the first year, you only get to deduct 1/10. So that would have been $10,000 your first year, then $90,000 divided by 5 for the next years until it's fully depreciated, right? So, and when it came to foreign research and development, you could only deduct 1/15, right? So basically, you pay the developer in a foreign country. Excuse me. You only get to deduct 1/15 of that, right? So, and that was a huge cash flow issue, because people were like, okay, I spent like $500,000 on my developers, and I still have to pay tax. I physically don't have money in my bank account to pay tax on it, right? So, and that was a problem. Now, when it comes to foreign research and development, that stayed the same. So if you pay your developers in different countries, you still have to depreciate it. You can't expense it right away. However, if you paid your developers in the United States, you get to deduct it as an expense. And I know 6 months ago I said it's unlikely to pass for 2025, but I was wrong. So it passed for 2025. So you can do it in 2025 as long as they're based in the United States. You just get to deduct them. And there's also something else related to research and development, because oftentimes my clients tell me, "Hey, all my developers are based in other countries because it's too expensive to hire a developer in the United States." Well, not really, because yes, you pay more cash. However, there are two reasons. If you hire developers in the United States, you may be better off compared to other countries. Um, Reason number one, you get to deduct that expense. You spent $100,000 on a research and development on your software developers. You get to deduct all of that right away, right? And number two, there's something called research and development credit, which typically applies to your software developers, right? So, which is you can get up to 30% back from the government, typically applied as a payroll tax credit. So, when people are saying, oh, if I hire a software developer, pay them like $200,000 a year, then I also have to pay payroll taxes on top of that. Well, typically, you are able to get that payroll taxes back if they're engaged in research and development, right? And you can carry it forward uh, in a future as well, right? So that's why there's so this the research and development credit existed before, but I just wanted to emphasize that alongside with being able to deduct your research and development expenses as right away gives you a huge incentive to actually hire in the United States your software development team. Uh, now, also, just like slightly touching the foreign shareholders, right? People oftentimes ask me if, with the new administration, uh, like, do we really can actually non-U.S. residents conduct business in the United States, have a corporation? The answer is generally yes, unless you are from a sanctioned country. Anyone can, and I think Dmitry also discussed that anyone can practically form a corporation in the United States as long as you are not from those like 7, 8 restricted countries, and you can generally conduct business as long as you pay the taxes, right? And as long as you file forms like 5472 for each foreign shareholder owning 25% or more, 5471 anytime a U.S. shareholder. A U.S. corporation owns 10% or more in a foreign corporation. So you can generally conduct business, you can hire employees in the United States. And yeah, now also speaking about personal taxes, right? If you're a U.S. resident, you file taxes in the United States, right? Couple of also key updates, especially for like middle class and low income people. So you can deduct $25,000 in tip income, right? So if you're in an industry that receives money as tips, you can typically exclude them from your income for up to $25,000, right? And in the United States, that's basically every industry is a tip-based industry. Like you would tip up your plumber, you would tip obviously the waiter, the barber, hairdresser, the driver, right? So you get to deduct that, right? So and also overtime. Some of overtime compensation is also excluded from taxes, right? So you can move to the other slide. So this is basically exactly what we're talking about, the bonus depreciation and the research and development expenses. As long as they're in the United States, you get to deduct all of them. And then, yeah, foreign shareholders. Yeah, so as I said, corporations, regardless, they're owned by foreign shareholders. Uh, yeah, I mean, I know no one tips accountants either. So yeah, we are the only ones exempt from it. All right, so um, yeah, so you still pay 21% net income tax. Now, when it comes to a dividend withholding, right? So this is something important to understand. If you have a corporation, right? So and you are not a U.S. resident, you can typically pay yourself a reasonable salary. Let's say your corporation's revenue is $1 million. You pay yourself $200,000 reasonable salary. And that's a tax deductible expense. And typically that's not taxable in the United States, right? That's exempt from taxation. However, if you leave the money in a corporation and you choose to pay yourself dividends, so basically instead of paying yourself a salary, let's say you made 1 million in revenue, then you spent $800,000 on operational expenses, then you left the $200,000 in the corporation. You would pay 21% corporate income tax on that, which is what, like $42,000. And then from the remaining money, if you send it to yourself, that will be a dividend income. which is subject up to 30% of withholding, which means the corporation will have to immediately withhold up to 30%. Some countries, especially European countries, have treaties with the United States that decrease it up to down to 5%. I would say most European countries, it's about 15%. But still, right? I mean, it's a money that you lose. So for a corporation with revenue about, let's say, $800,000 million in revenue, it's best practice to pay yourself a salary, right? Can move to different. So I mean, it's basically very what we already discussed. Can move to the other slide now. Actually, let's stay on this one. So yeah, and then I'll also quickly talk about what LLC versus corporation taxation. This is also something to say that foreign owned LLCs, as of right now, there's no special tax on foreign owned disregarded entities. If someone doesn't know what is a foreign owned LLC, basically it's when a non-US resident forms an LLC in a US state and claims that they do not conduct any business in the United States. So if they provide services, they can provide services in Europe, in any other place, right? As long as it's not a sanctioned country. They can typically open a bank account in the United States. They can even get paid from clients in the United States. And that income is exempt from taxes, right? And as of right now, they haven't implemented any taxes on foreign owned LLCs, as long as you don't conduct business in the United States. Now, obviously, your country of residence will most likely try to tax that income. But as far as the United States, it's not subject to taxation. So I will probably stop here and see if anyone has any questions. Could be about the new provisions, could be about taxation in the United States in general.
All right, thanks, Tigran. We have so everyone, please prepare your questions. This is the time to ask Tigran. Probably would have about 20-30 minutes with Tigran. We may stay a little longer if needed. This is our context. If you have any questions, like you forgot something and you want to follow up or something about legal or tax matters, just go and email us at info@goglobal.world. We will respond personally to you on your personal question as detailed as we can. So don't worry, and if you don't have a question now, you can do it later. And if you need help with tax accounting, this is the email to contact us, or you can contact Alex in the chat. So I will stop sharing, Tigran, if you don't mind.
Sure.
And I will put myself back to the stage. So we have first question from Azar. How can it be zero tax if some customers are in the United States or on the foreign-owned LLC?
So generally speaking, having customers in the United States doesn't make your income taxable as long as you're not a corporation, right? You're an LLC. Your LLC has not made an election to be taxed as a corporation. All LLC members are non-US residents, right? So meaning you're not a citizen, you don't have a green card, and you were not present in the United States 183 days during the year. Well, during last 3 years, counting all days during the current year, 1/3 of the days last year and 1/6 of the days the year before. As long as that number is 183 or less, then you're not a US resident. So in that case, and also you're providing all your services outside of the United States. In that case, your income is typically excluded from US taxes.
Perfect. Any more questions to Tigran? Please raise your hand, and if you want to speak, it would be ideal actually to have this conversation with you guys, or type a question here in the chat. We are there for you. Okay. Azar is following up on that thing. Internet is also considered to be outside the United States.
So if Azar can specify a little bit, like what exactly does he mean by internet? Does he mean like software as service when he sells his services via internet?
Yes, I mean software as service.
Software. Okay, so and you're not selling anything tangible, right? It's just software.
Yes. That's correct.
Just software. Yeah. So in that case, it will go by where the software is being written, right? So not where it's being sold. So it's still exempt from federal income tax. However, there's a catch. Some states have a right to tax your software as service. We had a different actually webinar about software as service and sales tax. Generally speaking, now if you are in Delaware, Delaware exempts you from sales tax. So there's no sales tax in Delaware, right? But generally speaking, if in any state your sales exceeded their economic nexus threshold, which is between $100,000 and $500,000, that state may require you to register and start collecting sales tax from your customers. Now, sales tax is not a tax that you pay yourself. It's a tax that you add to the price of your product. I know in many countries where you go to a store, it says $10 or 10 euros, you just pay 10 euros. In the United States, you go to a store, it says $10, you pay a little more, you pay like 11, right? Because we always add sales tax and to the price of the product, right? So essentially, you are exempt from federal income tax, right? If it's just software as service, it's written outside of the United States, and you don't have physical locations in the United States. And yeah, so in the United States, however, if you see your sales are approaching $100,000 in a specific state, let's say you see you're in Arizona, your sales were close to $95,000 last year. At that point, it may be worth keeping a closer eye to your Arizona sales. Then we would need to check if Arizona tax software as service. Generally, Arizona does tax software as service. And at that point, you will need to register in Arizona as soon as you hit that $100,000 threshold. Yeah, at that point, and you will need to start collecting sales tax on all your sales from Arizona.
All right. So you have another question.
Okay,
Yeah, Dima. Okay, go ahead, and then we'll ask Aika's question.
Yeah, just a quick follow-up. My clients are affected by deduction and amortization in R&E, which is now R&D. Now it's called research and exploration. Because a lot of, basically right now, as I understand, you can capitalize over the period of 15 years, correct? So can you tell, our listeners a little bit more about the strategies as to how can a company that is located in the United States, but then orders outsourcing services in Europe, mitigate this negative things, such as I recall, but I'd like you to maybe elaborate a little bit more as a specialist, because that's a little bit out of my purview. I know that we've done redoing the contracts, and instead of R&E, it was maintenance, marketing. And so what is right now R&E? What is the adjacent services that can actually be deductible rather than capitalized?
Yeah, thanks for the question. Yeah, I will respond to your question next. So yeah, prior people would just receive an invoice from a software developer, pay them, and that's basically it, right? However, now because software development is typically considered a research and development, and if it's outside of the United States, it must be capitalized over 15 years. So one strategy is to basically split the software development into different jobs, right? So now what is considered research? It is anything that's an asset, right? So, and then what's an asset? That's your code, right? Something that can be reused in the future, right? So I can give you an analogy with a car. The car itself is an asset, but if you change the paint on a car, that's typically a one-time service. That's a small improvement, right? So same with the software. When you do small bug fixes, when you do QA analysis, when you do small changes to the code, when you do minor updates, these are all exempt. They are not research, right? These are one-time changes, which are not assets, which means we can deduct them, right? So what does this mean? In the invoices from your software developers, you can ask them to detail, right? So what was the actual code that can be reused, which is mostly the backend development and some front-end features. And then let's say it's a $10,000 invoice, $4,000 was for the backend, right? Let's say then the software developer can say, I spent 2 hours also on QA, right? So $1,000 was the QA, right? Making sure the code works properly. I had to do some bug fixes as requested by my customer, right? So another $2,000 was your bug fixes, right? Um, feasibility analysis, right? So me and my software developer have a phone call where I'm asking, hey, can we do software that actually helps, cars fly? They're like, no, because you need the hardware for that, right? So, okay, the time for that call is also not considered a research and development, right? So these are main. So I would say bug fixes, minor updates, feasibility analysis, consultations, and QA. So this can be excluded, and it's the best practice to actually detail that in an invoice. So if you get audited, you can show them, well, this was my software development, but the rest is not.
All right, so let's move on to Aika's question. And Aika is asking me about the R&D deduction. Can I deduct the salaries of developers outside the United States?
So yeah, that's basically exactly what we just discussed. Generally speaking, back-end code that can be reused in the future, and also some front-end code that will be reused in the future, cannot be deducted right away. It must be depreciated, meaning you paid them $15,000. You can only deduct $1,000 per year, right? So it doesn't mean it's lost completely, but you deduct $1,000 this year, then another $1,000 next year until it's fully deducted, right? So you have to do it over the course of the time. However, if your developers can split their invoices into, as we just discussed, right? Development per se, then like bug fixes, QA, feasibility analysis, right? That way we can at least deduct some of it. I would say, depending obviously on the type of development, but I would say about typically between 40 and 60% of this expenses right away, and then the rest will just depreciate.
All right. Any more questions to Tigran on your tax filing, Delaware C Corps, California taxes, personal taxes, anything that you guys might be struggling with or not fully confident with? Please ask. So I can say while you're thinking of your questions, Tigran is so experienced in optimizing taxes. There are plenty of legal ways of optimizing your taxes, so then you can save your cash flow to reinvest back to the business. So this is probably your opportunity to ask. And of course, there has to be more detailed conversation personally with you. But also, Tigran, if you may, while we're waiting for more questions, maybe you can add a few hints on personal taxes while we didn't touch much on that. There are plenty of entrepreneurs pay themselves salaries and it's just W-2 salary. They sometimes have consulting on the side or something. There are plenty of people working for corporations on W-2 having really good income. Sometimes they have in their family one person is not working, the other one is working, and they file as a family. So what would be your high level recommendations to optimize personal taxes nowadays, considering that sometimes there is like a side business, like some consulting business, and to save some money for the family, for the cash flow, for the business.
Yeah, so generally speaking, right, so your taxes are a direct function of your income, right, and also of your family status and the number of children you have, right, and also your deductions, right? So in essence, if your net taxable income is $1 million, you will pay a lot of tax, right, in essence, right? So there's no magical way not to pay tax on, let's say, $1 million of taxable income. However, there are ways to defer that income, right? Or to put it in different taxation categories, right? So so let's say there are essentially three ways of paying yourself, right? As a W-2 employee, as a 1099 contractor, or as a K1 distribution from a partnership or an S corporation, right? So when it comes to W-2, now if you work for someone and they basically want to have you as an employee and they give you a W-2 form, it's generally very straightforward, right? So like they already do your deductions, and then you just upload your W-2 in your tax return. Then you claim maybe some deductions for having children, for paying for daycare, right? And then basically we just do the numbers, right, and tell you how much tax you may receive back, or maybe you owe a little bit, right? However, if let's say you are a 1099 contractor, right? And what is a 1099 contractor? Basically, you are an independent contractor. You choose when to work, where to work. Your employer can just generally control, give you like general assignments, right? So I need this done by, let's say by the end of the month, I need like this 5 projects done, right? But then, and as long as the results are acceptable, you're good to go. But I'm not gonna micromanage everything you do. That's an independent contractor. And no, you don't have to have a registered business to be an independent contractor in the United States. Now, however, you are considered a self-employed, and you get to take advantage of many business deductions. So let's say you have a $100,000 1099 income, right? So now from $100,000, you'll pay a significant amount of tax, right? Depending on your state, your family status, but it's significant. However, you can reduce that by using business-related deductions. So for example, if you work from home and your office at home is used exclusively for business, and I get this question a lot, can I deduct my home? Well, yes, but that part of your house should be exclusively used for business, right? So if you have a bedroom, you don't live in that bedroom, you don't sleep in that bedroom, you only conduct business in it. Or I don't know, maybe you are maybe you open a gym in your garage and use your garage as a space for your business. In that case, you can deduct it. Now, of course, you cannot deduct your full, mortgage or rent. However, you can deduct the portion proportionate to basically the size of the space that's used exclusively for business. So, for example, if the size of your apartment is 1,000 square feet and place used only for business is 100 square feet, it means your business use coefficient is about 10%, right? Now, this means that all reasonable expenses with, the rent, utilities, Wi-Fi, right, they can be deducted at 10%, right? So if your rent is, let's say, $3,000, your utilities 500, and then your Wi-Fi is, let's say, another 300. So you get to deduct $38,000 times 10%, which is $380 per month, right? So that's a deduction. The home office. Other deductions. If you buy a laptop to use for your business, if you buy a phone to use for your business, as long as you use those for 51% or more of the time just for business, you get to deduct them as business expenses, right? Things like paper clips, like small office supplies, you also get to deduct them. Now, some online subscriptions, right? If you have to be subscribed to things like ChatGPT because you use ChatGPT in your everyday tasks, you have to subscribe for the paid LinkedIn. You get to deduct them too, as long as you use them for business 51% of the time, right, or more. Your car, right? So if you buy a car and you use your car to see your clients, to see your investors, right? Or to, I don't know, driving for business in general. You get to deduct your car. There are 2 ways of doing it, right? One way is the standard mileage, which was increased to 72.5 cents this year, meaning for every mile you drove for business, you get to deduct 72.5 cents. You drove 10,000 miles for business. I don't know, you did like a road trip to Texas to meet clients at events. You get to deduct 72.5 cents times the mileage. And it could be, and it's for the round trip, right? If you drive there and then you come back, you get to deduct all of that, right? Now, the catch is if you use the mileage, you don't get to deduct things like gas, repairs, car depreciation, or insurance, right? So you get to deduct the interest paid on a car, but not the insurance, registration, depreciation, gas, or or repairs, right? So you have to choose, right, between mileage or actual expenses. So if you're like, okay, I only drove about 100 miles, what am I gonna deduct? Like $72? That's not a lot. Well, you can use the actual expenses, which is you finance your car for $20,000, right? And you use your car for business, let's say 70% of the time. So you can deduct 70% of $20,000 plus 70% of gas, insurance, registration, title, right? So,
Yeah, I will ask that question. Finish your thought.
Yeah, so that's what. So you can that's how you get to deduct the car expenses, right? So now, also, the catch is that if you buy a car and you started with the mileage, you have to continue with the mileage, or if you started with actual expenses, you have to continue with actual expenses, right? So these are a lot of expenses that can help you mitigate your tax risk, right? So basically, your revenue was 100,000 with all these expenses. Now your revenue is, your net income is about 50, 60,000, and obviously your taxes proportionally less, even higher proportionality because of marginal tax rates. And the last one is a strategy called S corp, right? So if you receive income, you can always form an LLC. Then you can choose for that LLC to be taxed as an S corp. That's very simple. Opening an LLC can take you maybe a week in California, like 10 minutes in Wyoming, or I don't know, 2 days in Delaware. That's basically registration of the LLC. Then you just send a letter to the IRS. It's called 2553, where you choose to be taxed as an S corporation. And then what you do, so you have $100,000 revenue, or actually let's say 200, because with 100,000 S corp doesn't really fit in S corp range that much. But with 200,000 revenue, you can pay yourself a reasonable salary, which is, let's say in California, that's like $100,000, right? And that salary, sure, it's subject to payroll taxes, income tax, all of that. However, the remaining $100,000, now, of course, you can use a lot of deductions, but whatever's remaining is passed on to your personal tax return on a form called K1, and that's not subject to self-employment taxes. Plus, in addition, S corporations can open something called SEP IRAs. SEP IRA is a retirement account for self-employed people, and an S corporation can deposit up to $70,000 a year into a SEP IRA, and that's a tax deductible, right? And that money basically, you can't touch that money until until you retire, right? So, but you still have some control over that money, right? You can choose how it's invested. You can take a loan against that money in most cases, and if some emergency happens, then you need to get that money back. You can always get that back, paying some small penalty and back taxes, but it's not like it's completely gone, right? Until you retire. And generally, you need a retirement. You need something on a retirement, right? So we're not going to be young forever. So S corp generally, even though it provides you with less job security, even though it has more admin costs with filing all the tax returns, generally typically gives you the highest tax savings. And also, one more aspect I wanted to touch: if you, let's say, want to buy a house, right, and you want to finance your house. There's something to keep in mind, that if you are self-employed, most banks don't like you because your income is not, you don't have income stability, right? So you have to provide, basically you have to show that 35% of your income is enough to pay, your monthly net income is enough to pay your mortgage, right? Which, to buy something in California, you basically have to make like $500,000 or something like that, right? A lot. However, if you're on W-2, typically that's 50%, right? With an S corp, even though you remain self-employed, you still get to issue yourself a W-2. So you are able to show some W-2 income, which will make you a more dependable borrower in the eyes of banks, right? So so these are like main. Obviously, there's a lot more, but just to go over, W-2 versus 1099 versus S corp, self-employed, S corp owner, employee taxation, just to give an idea of how we can play with this to legally reduce your taxes.
Yeah, and just quick touch. You're not an immigration lawyer, but just from S corp perspective, who qualifies for S corp, if you're aware of?
So you must be a U.S. resident, which means all shareholders of S corps must be U.S. residents, and they must be individuals. So no corporate owners, no foreign owners. Now, by U.S. resident, obviously we mean U.S. citizen, green card holders. And then IRS typically defines U.S. resident as someone who has a work permit, so allowed to work in the United States, that's unrestricted, and also who's been present in the United States for 183 days, counting all days in a current year, one third of the days in a previous year, and 1/6 of the days in the year before. So in those cases, you qualify. Now, full disclosure, if you're not a citizen or a green card holder, highly advised to speak to an immigration lawyer if having an S corp will not hinder in any way your immigration status, but IRS will be okay with you. As
All
long
right.
as you have a work permit that allows you to accept like most types of employment.
Perfect. So yeah, on this kind of questions, please consult immigration lawyers. We know a lot of amazing immigration lawyers. So if you guys need some contacts, we can refer good guys. Just let us know. We are there for you. Happy to connect. So Dmitry is asking if the other Dmitry, by the way, if a U.S. corporation provides software development services to U.S. clients, but subcontractors 100% of the work to a European entity, would the R&D deduction still apply? Thank you.
Okay, so if there's a U.S. corporation that provides software services to another U.S. corporation, software development services to another U.S. corporation, but that the service provider outsources to foreigners, right? To foreign developers. That's the question, right?
Dmitry, could you please clarify the question? He said yes.
Okay. So in that case, typically, the U.S. corporation will be able to deduct their research and development right away. However, the provider of services will typically have to depreciate that, unless they serve. But here's a catch here: if the U.S. corporation serves as an intermediary, the U.S. provider serves just as an intermediary, right? So like basically uses the model of Upwork where you just hire people, then you become the direct the foreign software suppliers, right, become your direct contractors, even though there is a shield and it may give you some protection, but typically in most use cases IRS will consider them as being your direct contractors. Now so basically here if the foreign software developers work or are contractors of the US entity, and they provide services to US entity, and then the US entity sells you the software, right, or directly, then then you would qualify for a research and development deduction. However, if if it's just an intermediary like Upwork or Fiverr, then typically in most use cases it may go through with your tax return. It may not catch an immediate attention by the IRS, but if you get audited, in most use cases IRS will demand that you depreciate it.
All right. Any more questions from everyone? All right, Dmitry, thank you. Okay, we have Adam. Okay, I have to drop. Okay, Adam, thank you. Any more questions, anyone? I have a question before maybe we have about 10 minutes more. We don't have to stay that long. I just want to give an opportunity to guys to ask a question. But one of the very frequent questions I hear, do I really need accounting? So why people do accounting? Why does it matter for tax purposes, audit or something? How soon should you start the accounting? Maybe what software can you advise for startups who just started? And usually they ask like, why don't I give you like my bank statements and you do it? Like, would you be responsible for my accounting or something?
Yeah, I mean, look, it's like imagine you're interviewing someone for a job, or I don't know, you are just you just met someone you want to do business with. I mean, and then they come completely unprepared. They are in a wrinkled shirt, like their hair is a complete mess. Your first impression will be pretty bad, even though that's a great person. That could be a great person, like great professional, but first impression matters, right? So the first thing I want to say about accounting, even if your business is not doing anything illegal, is not doing anything wrong, right? So if you're audited by the IRS and the IRS sees an accounting, a properly made balance sheet, P&L, properly stored invoices, there's much less questions they ask, right? Yeah, right. So if you send the IRS your balance, I mean, most audits are conducted over mail. Very rarely, IRS will actually come and see you in person. But if they request your balance sheet and your P&L and you send it to them, and it's in order, then they will randomly check a few invoices. And generally speaking, that's all they need to know. But if IRS wants to audit your tax returns, and instead of that, you just send them some Excel spreadsheets that are not done according to GAAP, right? Generally accepted accounting principles, right? So some deductions that may be questionable, right? So they seem like personal, even though they were not personal deductions, right? The impression is that, okay, this person is not doing a proper accounting, right? So I would say that's like one compelling reason to actually have a professional accounting, especially if your assets are above $250,000, because in that case you also have to send your balance sheet to the IRS, right? So it's first of all to properly figure out how much money you made, how much money you spent, and what was your net income, of course, and what are your assets, your liabilities, and your equity, right? And also, so make sure you don't pay taxes on income you didn't earn. You get to properly deduct your expenses. You don't by accident deduct personal expenses, right? You keep your business expenses separate from your personal stuff, right? That's important. But also, to be able to substantiate an audit, right? So that's exactly why you need accounting.
All right, thanks. Anyone else have any more questions related to your business taxes or personal taxes? And in case of, Azar is asking, in case of a new LLC in Florida with a single foreign non-US person owner, there are no transactions on LLC exempt for operating US bank account and depositing 500 USD. Does this trigger US federal and state tax filing except for the Florida annual report?
So it's a single member LLC. It's foreign owned. There are no transactions, just a $500 deposit. Okay, so generally, foreign owned LLCs must file Form 5472, attach it to 1120, just the first page of 1120, and either mail or fax it to the IRS every year. And that $500 deposit you made will be listed on the Form 5472 as basically a transaction between the LLC's member or owner and the LLC itself. Now, the good news is it's an informational return only, which means you don't pay any income tax on that return. But you still have to file the return, and the penalties are actually crazy on that. It's $25,000 even if you are 1 day late. So you must file it before April 15.
Oh my God, that's a high one. And if just to follow up on that, quite often there are entrepreneurs who raise capital, like say $500,000, $1 million, or a few $1 million. They have no revenue, like zero revenue, but they have like tons of expenses.
April 15, Azar.
Yeah, you need to file by April 15 for your case. So they have raised capital. They have hired a team. They do a lot of stuff, like business is running. They have a lot of expenses, but zero revenue. So consider this as like zero transactions, like so zero taxes. Company, do they need to file taxes? I know it's like basic question, but it's quite frequent question from many entrepreneurs. Like,
Sure.
do we really need to file taxes and why?
So all corporations must file tax returns. It's just a requirement by the IRS, even if you had zero transactions. And also all single member foreign owned LLCs must file taxes, even if they didn't have any transactions, right? So that's important to know. Single member LLC owned by a US resident, if you had no transactions, no income, you don't have to. But I would suggest you still include it in your personal income tax, because you get to deduct some like legal fees you spend on that LLC. Partnerships, if had zero transactions, don't have to file a tax return. But yeah, corporations and foreign-owned LLCs must file tax returns even they had nothing. Now, luckily, on a federal level, the income tax, we only have income tax that's based on your net income. We don't have tax based on revenue. We don't have tax based on your assets on a federal level for most businesses, right? With very rare exceptions. So typically, if you have zero revenue, zero net income, you don't pay any income tax.
All right. So if no more questions, we will start closing. But if you have, this is your time probably for one last question. Dmitry Dubograev and Alex Zlotnikov, if you can turn on your cameras, I probably put you on the stage for a final group photo. Give me a sec. But final question, Tigran, I have. Say I'm a startup running a business, raise capital, and I have Delaware C Corp, which is very common with our audience. And I am located and running my business in California. Do I owe anything to California, or if I run my business in other state? Basically, I'm in C Corp, have C Corp Delaware. Business is running. I get my tax Stripe account, business account, everything is in there. But I'm in California, so am I all compliant with taxes, or do I need to do anything else?
So if you're physically based in California and you're actively running your business, that's most likely a physical nexus. So you would need to register in California and pay the franchise tax. And also probably if you have revenue, you should also apportion a part of the revenue that's coming from California sources basically to your California tax return. And you must pay minimum $800 franchise tax a year. California is pretty expensive. And maybe, Dmitry can also elaborate on if there are any legal consequences for not registering, such as if someone files a lawsuit against you in California.
Yeah. Jim, if you can 10, 15 seconds,
So there are two legal aspects. If you and where is the corporation initially registered?
C Corp Delaware, but
Delaware.
business.
So basically, if you were C Corp Delaware, you could do interstate commerce anywhere you want, California or other places. There's a thing called doing business or registration to business, or also called qualification. So if you have an office or presence, others, you must register in that state. This is like for those of you who speak Russian, business propiska. This is your kind of place where you conduct business out of. And however, if you must register in California and you didn't, then you actually reduced in your rights. Like you can initiate a lawsuit or do other things. But if you are a Delaware corporation and do interstate commerce, including Delaware, including California, it's okay. But if you were subject to specific, and this is analysis of your particular circumstances versus particular law of a particular state. So there's no silver bullet. Unfortunately, we have to kind of look at what you do. Then it is highly advisable to do qualification if you are required. If you don't, there are negative consequences, fines, and other things. Like you just have to stay compliant.
Thank you. And the good news, it's not expensive. Literally, it's part of standard process usually. So don't be afraid that it's gonna be a huge burden for you, extra thing. It's actually not that much, and it just protects your business way more. Tigran, we have a final question from Azar, a quick one, and we then do a group photo. So those forms 5472 and 1120, can a person send it to IRS, or they need to have an agent for that?
No, you don't need to have an agent. I mean, it's advised to have, someone who knows someone who's done this before do it, like a professional do this. But no, there's no restriction. You are allowed to download the form, fill it out, and then either mail or fax it to the IRS.
All right. So that was Tigran Harutyunyan, my co-founder and partner at GoGobo World, GGW Services. We are crushing it in the US market, helping so many entrepreneurs, and we are there for you when you guys need us. So I'm gonna do one final thing that we traditionally do at GGW. So I'm gonna change the room, and here, like we have Dmitry, I put here everyone like a. So I just want you guys just wave like this, and I'll do a screenshot. So that will be our group photo, and it would be. So look at the camera with your. Okay. So I'm doing this right now. Just okay. 1 second. You don't need to raise. Just a second. Once again. 1, 2, 3. Demo raise. Okay. Perfect. Okay, perfect. This is something we'll share on our social media, and everyone who is watching us, that was GoGobo World. We discussed legal landscape and tax landscape of 2026. We ask all your questions, appreciate all your questions, like really good questions. If you would have follow-on questions, just reach us out at info@goglobal.world. Alex from our team, he will handle all the communication with our customers. He will help you. And if you need any extra help, we are there for you. Just don't hesitate to reach us out. We will answer your question. Like I will direct it to Dmitry or Tigran or anyone that could be professionally give you support professional on your matters. With that said, GoGobo World is your partner on your business in the United States. Reach us out, be with us, and keep spreading the word, keep spreading the love to all the other entrepreneurs, and support us on social media. So then we can do events like this more and more. Take care. Thank you, Tigran. Thank you, Dmitry, Alex, and take care. Have a great the rest of the day.
Bye, guys. Thank you so much.
Thank you.